People will come to me and want to get started with investing, want to get started with planning for retirement, or whatever it might be, is just simply putting money aside. And the reality is a lot of times when they do come, they have really no idea, other than maybe a few preconceived notions of financial planning or where they put their money or whatnot. So as we get started here, I'm going to show you just 3 general locations that you can put your money, very much at a 30,000 foot view, diving down into very specifics. But like I said, if you had $1 and you wanted to put your dollar aside, your $10,000, $100,000, there are 3 general locations that you can put your money. The first location that you can put your money would be in some type of a cash equivalent location or cash position. If you were to identify a cash position, it would be one of a handful of different things, such as a savings account, a checking account, perhaps even some type of a money market account. Something that is very conservative, something that is very safe, highly liquid, but it is put away somewhere, if that makes sense. If I was to draw a graph over here on what this money would look like over time by way of a rate of return, if you will. If it's invested in one of these 3 types of locations, the rate of return is going to be extremely moderate. It's going to be conservative, and for multiple reasons, it's going to be fairly safe, but it's serving the purpose of being highly liquid. I take an ATM card and access money out of these types of locations at a moment's notice. So very liquid, and it's going to represent a low rate of return over time. The second place or location that I could put my money would comprise of fixed income type locations. When we talk about fixed income locations, we want to consider what we would call loanership dollars. Loanership dollars would comprise primarily of a bond type portfolio, where that bond is purchased at a certain price, if you will. Over time, it's going to fluctuate based on interest rates and markets and so on. But over time, you know that bond more than likely is going to be worth more than what you purchased it at, or at least that's the intent upon purchasing it. And you're going to earn an income over that based on interest and so on. The third place that you can put money is in an equities position. And equities, whenever you think of equity, I want you to think of, usually you think of equity in your home, or ownership dollars, if you will. So this one, you are taking ownership of that quote unquote investment. So whether it's a stock position and purchasing stock in a publicly traded company, the value of stocks can increase or decrease over time, or your investments in the market can increase and decrease in value. And it may look something like this. The reality is I don't know what it's going to do from here on out. Historically speaking, there's fluctuations in the market with no idea of where it's going to end up over a period of time. But the idea is that it typically and historically speaking has outperformed bond type locations or cash locations from a return perspective. Now, if this is our money that you're starting with when it comes to just beginning the retirement or planning for retirement process, at some point our goal or our objective is to build or accumulate a much larger bag of cash over a period of time. So with that being said, I need to begin my accumulation phase, or the accumulation phase of retirement, which is between the ages of in your early 20s upwards to maybe your mid 60s or late 60s, depending on when you got started. So the idea is that as you invest money into these different types of locations and over an allocation model, you can determine how to invest over these 3 based on risk tolerance, time horizon, and some things like that, that you can build or accumulate a much larger net worth, if you will, for retirement. Well, at some point down the road, the accumulation phase is going to stop. You're not going to be so worried about the growth of your assets or growing assets. You're going to be more concerned about the distribution of those assets. How do I get that money to put back into my pocket to spend for retirement or to enjoy those retirement years and enjoying the last 30 or 40 years that you've spent accumulating those assets? So at some point, like I said, the accumulation phase is going to stop, and then we're going to begin the distribution phase, and we're going to start enjoying that money. A lot of people are not really concerned during the accumulation phase what happens at this point. And it's usually when they come and sit down with us that those concerns arise with what happens to my money upon distribution. So upon distribution, three different things, or potentially three different effects on your money upon distribution. The first thing that could potentially happen is your money is in a fully taxable location. A fully taxable location would be an area such as 401k, IRAs, pension, and so on. Anything that is being put in tax-free, or pardon me, tax-deferred. So you're putting it into a qualified location, you're receiving a tax-deferred benefit on that type of an investment, if you will, and then upon distribution, that money is going to be fully taxed at distribution. So a lot of people, when they sit down with us, they feel that their 401k is the answer. They feel that the IRA is the answer. And it may be. It may be a great portion of their portfolio, but they're not familiar with what could potentially happen to those assets upon distribution, where they can be fully taxable upon distribution. The next place is a partially taxable location. Partially taxable location would be areas such as money that you've invested with after-tax dollars, where you've gone out, you've put your money into different types of locations and investments, if you will, and they are taxed at a capital gains tax rate. Which can potentially be lower than a fully taxable location, depending on how long you've held the asset and so on. The last place that you can put money or pull money from is in a tax-favored location. A tax-favored location would comprise primarily of muni bonds, Roth IRA is another one that you can access money on a tax-favored basis at retirement. And then there's different types of life insurance policies that you can access the cash value on a tax-favored basis also, not only during retirement, but prior to retirement as well. The question that you have to ask yourself is, where do I see taxes being at some point down the road? So are taxes going to be lower than where I am currently? So from a tax distribution perspective, if it's going to be fully taxable at distribution, and I am in a low tax bracket right now with the thought or the idea, or potentially because of economics or career path, that I could potentially be in a higher tax bracket at retirement, does it make sense to fully fund a qualified plan at a low tax bracket when I could potentially be in a higher tax bracket in retirement? So one of the questions that you have to ask yourself is it more beneficial to pay taxes on the seed, or is it more beneficial to pay taxes on the harvest? A lot of that's going to depend on your tax situation at retirement. So understanding where you're at from a tax standpoint now, what your tax situation is now versus what your tax situation is going to be at distribution, how am I going to be taxed, and what's going to be the effect of this money, if you will, when it comes time to actually spending it and living on that money. So by following an asset allocation model, not only from an accumulation perspective, but also from a distribution perspective, are we suggesting that you should have all of your money in location 3, if you will? No. There's definitely wisdom in making sure that I have assets across all playing fields, regardless of current situation, because we don't know what down the road is going to be like. We don't know what the laws are going to be. We don't know what tax laws are going to be. And so it may make sense to make sure that I have money in all 3 different types of locations.